Hello everyone and thank you for joining today's True Trading webinar. I'm excited to be here with you. My name is Mohammed Azim from Traders United. Risk disclaimer. True webinar house rules. Please take the time to read important rules for webinar attendees. Let me start by sharing a little information about myself. I am a certified Elliott Wave analyst, having earned my level 1 certification back in the year 2012 with a score of 93%. This certification deepened my understanding of market behavior, especially through the lens of Elliott Wave theory. In addition to my work as an Forex analyst, I am also an author and educator. I wrote Introduction to Elliott Wave Theory, a book designed to help traders like you build a strong foundation in understanding the intricate structure of market waves. But my expertise does not stop at Elliott Wave. Over the years, I have expanded my knowledge into broader market analysis, diving deep into market trends, chart patterns, and price action strategies. So, whether you are a beginner or an experienced trader, I aim to provide you with valuable insights that will help you navigate and succeed in the Forex markets. With that, let's dive into today's session. These are the session goals. Let me talk about macroeconomic events and data releases. I am going to cover previous week fundamental analysis. The first one is the core PPI and the second one is the GDP. Let's start with the first one. So last week on July 15th at 12:30 p.m. UTC time, we got this important Forex news announcement, the core PPI month over month in USA. Now, let me explain what is core PPI M over M. Core Producer Price Index month over month measures the change in prices that US producers receive for goods and services excluding the volatile food and energy sectors. It is an important indicator of underlying inflation in the United States. The report helps traders assess inflation trends before they reach consumers. A higher than expected reading suggests stronger inflationary pressure. This can strengthen the US dollar and push Euro USD lower. A lower than expected reading may weaken the US dollar and lift the price of Euro USD higher. So, in simple words, core PPI M or M means month or month. It measures the monthly change in prices received by the US producers for goods and services, excluding food and energy. It is published by the US Bureau of Labor Statistics. The core PPI is a leading indicator of inflation because higher producer costs may later be passed on to consumers. The Federal Reserve in USA closely monitors this report when making interest rate decisions. Now, let's take a look at some of the numbers. The previous reading was 0.1%, forecast 0.3%, and the actual number we got is 0.2%. Markets expected core PPI to rise to 0.3% from the previous 0.1% number, indicating stronger producer inflation. Forex traders closely watched whether inflationary pressures would accelerate or remain contained. A reading above the forecast was expected to strengthen the US dollar, while a weaker reading was expected to weigh on the dollar and support euro dollar currency pair. Now let me discuss the market reaction. The core PPI increased by 0.2%, below the market forecast of 0.3%, but above the previous reading of 0.1%. Following the release, the price action of euro dollar currency pair actually moved higher. It moved up inside this daily time frame. Now, why euro USD moved up? There are several factors contributed to the bullish move in euro dollar currency pairs. The core PPI came in at 0.2% below the 0.3% forecast. Softer producer inflation reduced expectations. The weaker inflation data pressured the US dollar. Lower Treasury yield expectations also weighed on the United States dollar. Currency traders increased demand for the euro following the softer US dollar inflation report. So overall market sentiment favored euro USD currency pair after the news release. The combination of these factors created bullish momentum in euro dollar currency pair following the news announcement. The key market drivers observed: the core PPI actual 0.2% versus the forecast 0.3%, which is below the expectations. Producer inflation remained below market expectations, reduced expectations for aggressive Federal Reserve policy, broad US dollar weakness following the release. Market sentiment shifted in favor of euro USD. Now, let me discuss technical and sentiment considerations. Although core PPI increased from the previous month, the reading was below market expectations, signaling that producer inflation remained relatively contained. Currency markets responded by selling the US dollar as traders reduced expectations for tighter Federal Reserve policy. Following the initial reaction, traders continued to monitor upcoming US inflation data, Federal Reserve communication, Treasury yields, and overall market sentiment for confirmation of the broader trend. As far as the trading outlook is concerned, the short term bias is bullish in euro dollar currency pair. If I zoom in a little bit, you can see that this was the resistance and market exactly hit that level, dropped a little bit. But the way market is behaving, it's actually inching up over here. What I mean by that is you can draw a simple trend line. Okay, here's another one. So as long as price action is staying above both of these trend lines, it looks like to me the short-term bias is bullish for the euro dollar currency pair. If future US dollar inflation data continues to come in below expectations and Federal Reserve policy expectations become less hawkish, Euro USD could remain supported. However, currency traders should continue monitoring upcoming US economic releases, Federal Reserve communication, Treasury yields, and overall market sentiment for additional direction. Overall analysis is the US core PPI rose 0.2% below the market forecast of 0.3% and above the previous reading of 0.1%. Although producer inflation increased from the previous month, the softer than expected result reduced inflation concerns and weakened the US dollar. Euro USD moved higher after the news announcement as currency traders interpreted the data as lowering the likelihood of more aggressive Federal Reserve policy. The report highlighted that inflation surprises relative to market expectations remained a key driver of short term euro dollar price action. The final key takeaway is the previous number was 0.1%, forecast 0.3%, and the actual number we got is 0.2%. The US core PPI rose to 0.2%, below the market forecast of 0.3%. The softer than expected inflation reading weakened the US dollar and pushed the Euro USD higher, as Forex traders reduced expectations for aggressive Federal Reserve policy and shifted sentiment in favor of the euro. The next important news announcement was the GDP month over month in United Kingdom. The date and time was July 16th, 6 a.m. UTC time. So let's discuss that. So what is GDP M over M in United Kingdom? GDP M over M means month over month, measures the month over month change in the total value of goods and services produced in the United Kingdom. It is one of the most important indicators of economic growth. The report reflects the overall health of the UK economy. A higher than expected reading signals stronger economic activity. This can strengthen the British pound and push the GBPUSD higher. A lower than expected reading may weaken the pound and send GBPUSD lower. So the GDP month over month measures the monthly change in the total value of goods and services produced in the United Kingdom. It is published by the United Kingdom Office for National Statistics. The GDP report is the broadest measure of economic activity. Strong economic growth usually supports the British pound. Weak growth may increase expectations for lower interest rates. The Bank of England closely monitors GDP when making monetary policy decisions. Now, let's take a look at the numbers. The previous reading was minus 0.1%, forecast 0.0%, and the actual number we got is 0.1%. Now, let me discuss market context and pre release expectations. Forex markets expected GDP to remain unchanged at 0.0%, improving from the previous negative reading of minus 0.1% reading. The expected stabilization suggested that the UK economy might be recovering after the previous monthly contraction. Currency traders closely watch the report for signs of stronger economic activity and its potential impact on future Bank of England policy. A reading above the forecast was expected to strengthen the British pound, while a weaker reading was expected to weigh on the currency. Now, let's take a look at the price chart and the market reaction. As far as the GBPUSD is concerned, the price action of GBPUSD kind of moved up overall. Now it's falling down. You can see the UK GDP increased by 0.1%, beating the market forecast of 0.0% and improving from the previous minus 0.1% reading. Following the release, GBPUSD moved higher as traders responded positively to the stronger than expected economic growth data. The stronger GDP reading boosted confidence in the UK economy, strengthened the British pound, and increased the expectations that the Bank of England could maintain a relatively firm monetary policy stance. Why GBPUSD moved up? Well, there are several factors contributed to the bullish move in pound dollar currency pair. For example, GDP rose to 0.1% above the 0.0% forecast. The previous reading was minus 0.1%. So the economic growth improved from the previous negative reading. Stronger economic data supported the British pound. Currency traders increased expectations for a relatively firm Bank of England policy outlook. Positive market sentiment favored the British pound. The stronger UK data outweighed the demand for the US dollar. The combination of these factors created bullish momentum in GBPUSD following the news announcement. The key market drivers observed is the GDP actual 0.1% number versus the forecast of 0.0%, better than expected. It's a positive number. Previously, we got a negative reading. So, stronger outlook for the UK economy, increased confidence in the British pound, market expectations favored GBPUSD following the news release. Now, let me discuss technical and sentiment considerations. The stronger than expected GDP report confirmed that the UK economy performed better than markets had anticipated, providing support for the British pound. Currency markets reacted positively as traders increased expectations that stronger economic growth could support the Bank of England's policy outlook. Following the initial reaction, currency traders continued to monitor upcoming UK economic data, Bank of England communications, US economic releases, and overall market sentiment for confirmation of the broader market trend. As far as the trading outlook is concerned, the short term bias, I would say, is somewhat bullish to neutral. The stronger than expected GDP reading supported GBPUSD by strengthening the British pound. If upcoming UK economic data remains resilient and Bank of England policy expectations stay supportive, GBPUSD could remain supported. However, traders should continue monitoring future UK economic releases, Bank of England communication, US economic data, and overall market sentiment for additional direction. So the overall analysis is the UK GDP increased 0.1%, beating the market forecast of 0.0% and improving from the previous negative reading of minus 0.1%. The stronger economic growth boosted confidence in the UK economy and supported the British pound. GBPUSD moved higher after the news release as traders viewed the stronger GDP data as supportive of the Bank of England's monetary policy outlook. The report demonstrated that stronger than expected economic growth remained a key driver of short term GBP/USD price action. The final key takeaway is the UK GDP rose 0.1%, exceeding the market forecast of 0.0% and reversing the previous minus 0.1% decline. The stronger than expected economic growth strengthened the British pound and pushed GBP/USD higher as forex traders increased confidence in the UK economy and the Bank of England's policy outlook. Now, let us take a look at previous week global market trends. The first one is the euro dollar, the second one is the US dollar Swiss franc currency pair. So let's start with the euro dollar first. As far as the weekly time frame is concerned, we got this trend line break over here. But the problem is this is the support, and so far price action did not manage to clear this support level. It's actually finding aggressive buyers over here. So if we go over to the daily time frame, you can see that we got this rally in price action. I have highlighted this in yellow color. So we got the rally in price action previously over here, and even over here as well. But this time it looks a bit different. And why is that? Because it's taking so much time to complete this pullback. Or on second thought, maybe this is not a pullback. Maybe this is the beginning of a short-term bullish reversal in price action of euro dollar currency pair. So if we go over to a 4-hour time frame, you can see that price action is printing higher swing highs and higher swing lows. So it's kind of telling me that market wants to move up over here and retest this resistance area. I will discuss more on the euro dollar later. Next one is the USD Swiss franc. USD Swiss franc, we got this bullish breakout, but again, same story. This is the resistance level right up over here in weekly time frame of US dollar Swiss franc, and market is currently finding some resistance over here. In daily time frame, we have this nice support of this upward sloping trend line over here. And in 4-hour time frame, market kind of uh, trying to go nowhere. We got a drop in the market, then it rallied up, and then dropped. Now it's again trying to rise back up again. So it looks like to me we're getting kind of a sideways price action in smaller time frame of US dollar Swiss franc. So it's quite possible that the USD Swiss franc is going to drop and breaks below this support area because we got this bullish rally, and this is where we're getting the resistance over here. Okay, so it's quite possible that market is going to fall back down, maybe retest this bullish trend line before it goes back up, or maybe it resumes the decline, the downtrend. Next, let me talk about the current week's macroeconomic events and data releases. I will be covering the key development in forex market with a focus on fundamental analysis. So these are the upcoming important news announcements. So July 22nd at 6 a.m. UTC time, CPI in United Kingdom, and the currency pair we're going to focus is the GBPUSD currency pair. The next important news announcement is the unemployment rate in Australia, and the date and time is July 23rd, 1:30 a.m. UTC time. So let's start with the first one. So what is CPI Y over Y in United Kingdom? CPI, also known as Consumer Price Index, measures the year over year change. So Y over Y means year over year change in the prices of goods and services purchased by the consumers in the United Kingdom. It is the Bank of England's primary measure of inflation. Rather, a higher than expected reading suggests rising inflationary pressure, which can strengthen the British pound and push the GBPUSD higher. A lower than expected result suggests easing inflation, which may weaken the British pound and push GBPUSD lower. Forex traders closely monitor this report because it can significantly influence Bank of England monetary policy. So the CPI year over year measures the annual change in the prices of goods and services purchased by consumers in the United Kingdom. It is published by the United Kingdom Office for National Statistics. The Consumer Price Index is the Bank of England's primary measure of inflation and plays a key role in monetary policy decisions. Higher inflation may encourage the Bank of England to keep interest rates higher or raise them further. Lower inflation may increase expectations for interest rate cuts. Now let's take a look at the previous number. So previously we got a 2.8% value, and the forecast is 2.7%. Actual data not yet released, but it is going to be released tomorrow on July 22nd at 6 a.m. UTC time. Now let me discuss market context and pre-release expectations. Markets expect CPI to ease to 2.7% from the previous 2.8%, suggesting inflationary pressures may be gradually moderating. Currency traders will closely watch whether inflation continues to move towards the Bank of England's target or remains elevated. A reading above 2.7% could strengthen the British pound by increasing expectations of tighter monetary policy. A weaker reading could weigh on the pound by supporting expectations for future interest rate cuts. Now, why GBP USD could move? Well, there are key drivers for potential price action, and that includes CPI result versus the forecast, UK inflation outlook, Bank of England interest rate expectations, British pound strength or weakness, US dollar strength or weakness, overall market sentiment, and other UK economic data. Inflation data is one of the most influential economic reports for the British pound because it directly affects monetary policy expectations. Let me discuss technical and sentiment considerations. GBPUSD could experience increased volatility following the inflation release. A stronger than expected CPI reading may reinforce expectations for tighter Bank of England policy supporting the GBPUSD currency pair. A weaker than expected reading may increase expectations for future interest rate cuts, putting pressure on the British pound and pushing GBPUSD lower. Forex traders should also monitor Bank of England communication, US economic data, and overall market sentiment. As far as the pre release trading outlook is concerned, the short term bias is somewhat neutral in GBPUSD currency pair. So expect bullish price action for GBPUSD currency pair if CPI comes in above 2.7%, and expect a bearish price action for GBPUSD currency pair if CPI comes in below 2.7%. If the report matches expectations, currency traders will likely focus on Bank of England guidance and upcoming economic data for additional direction. Expect increased volatility around the news announcement. The overall analysis is the CPI is the most important inflation indicator for the United Kingdom and a major driver of Bank of England monetary policy expectations. Currency markets expect annual inflation to ease slightly to 2.7% from the previous 2.8%. The outcome of this report could significantly influence expectations for future interest rate decisions and become a major driver of short term GBPUSD price action. The final key takeaway is the GBPUSD traders will closely monitor the UK CPI report for fresh clues about inflation and future Bank of England policy. A higher than expected reading could strengthen the British pound and push GBPUSD higher, while a weaker than expected result could weaken the pound and send GBPUSD lower. The next important upcoming news announcement is the unemployment rate in Australia, and we're going to focus on AUD USD currency pair. The date and time is July 23rd, 1:30 a.m. UTC time. Now, let me first explain unemployment rate in Australia, what it is. The unemployment rate measures the percentage of Australia's labor force that is unemployed and actively seeking work. It is a key indicator of the country's economic health. A lower than expected unemployment rate suggests a stronger labor market, which can strengthen the Australian dollar and push AUD USD higher. A higher than expected reading indicates a weaker labor market, which can weaken the Australian dollar and push AUD USD lower. Currency traders closely monitor this report because it can influence Reserve Bank of Australia interest rate decisions. Now the event details. The previous reading was 4.4%, and the upcoming forecast for the unemployment rate figure is also 4.4%. Actual data not yet released, but it is going to be released on July 23rd at 1:30 a.m. UTC time. So this report is actually published by the Australian Bureau of Statistics. The report is one of the most important indicators of labor market conditions and overall economic health. A stronger labor market supports consumer spending and economic growth, while a weaker labor market may increase expectations for lower interest rates. The Reserve Bank of Australia closely monitors employment data when making monetary policy decisions. Now, let me discuss market context and pre release expectations. Currency markets expect the unemployment rate to remain unchanged at 4.4%, indicating stable labor market conditions. An unchanged reading would suggest that Australia's employment market continues to remain relatively resilient. Forex traders will closely watch the report for any unexpected changes that could influence expectations for future Reserve Bank of Australia interest rate decisions. A lower than expected reading could strengthen the Australian dollar, while a higher reading could weigh on the currency. Now, why AUD USD could move? Well, there are key drivers for potential price action, and that includes unemployment rate result versus the forecast, Australian labour market conditions, Reserve Bank of Australia interest rate expectations, Australian dollar strength or weakness, US dollar strength or weakness, overall market sentiment, other Australian economic data report. Labour market data is one of the most influential economic reports for the Australian dollar because it directly impacts monetary policy expectations. Now, let me talk about technical and sentiment considerations. AUDUSD could experience increased volatility following the employment report. A lower than expected unemployment rate may reinforce expectations for a stronger Australian economy and support AUD-USD currency pair. A higher than expected reading may increase expectations for a more accommodative Reserve Bank of Australia policy stance, putting pressure on the Australian dollar. Now, as far as the price action is concerned, if we take a look at the price chart of AUD-USD currency pair, is a nice bullish trend line, and price action is still staying above the support area. So the bias is somewhat neutral over here in AUD-USD currency pair. Expect bullish price action in AUD-USD currency pair if unemployment rate comes in below 4.4%, and expect bearish price action for AUD-USD currency pair if unemployment rate comes in above 4.4%. The overall analysis is the unemployment rate is one of Australia's most important economic indicators and a major driver of Reserve Bank of Australia monetary policy expectations. The final key takeaway is the AUD-USD traders will closely monitor Australia's unemployment rate report for fresh clues about labor market strength and future Reserve Bank of Australia policy. A lower than expected reading could strengthen the Australian dollar and push AUD-USD higher, while a higher than expected reading could weaken the Australian dollar and send AUD-USD lower. Now, let us take a look at current week Forex market trends. I'm going to start with Euro dollar and then GBPUSD currency pair. So first one is the Euro USD. This is the weekly time frame. We got this trend line break, but market is finding support over here. So if market manages to break below the support level, then expect further weakness. Otherwise, it's quite possible that market is going to rise back up from current levels in euro dollar currency pair. In a daily time frame, I've showed you these yellow color highlighted boxes, which suggest that euro dollar basically showed us some pullbacks and then the continuation. But this time it's different. We got quite a bigger box over here. So these things usually happen when we get a bottom, like the way we got over here at the left hand side area. Let me try to duplicate this thing here, like the way we got over here at the left hand side. So we might get actually a bottom in euro dollar currency pair and this market could fire up. 4 hours shows a somewhat bullish trend over here as well. Next one is the GBPUSD currency pair. GBPUSD is currently finding good support at this bullish rising trend line, and it did bounce back up from this area. So this is telling me that market wants to go up. Even if market really wants to go down, still we want the market first to clear this support area. So if we go over to a 4 hour time frame, on a short-term basis, if market is going to break below the support area, then expect further weakness in price action of GBPUSD currency pair. Next, AUDUSD. Australian dollar is kind of uh, finding support over here. This is the support. We got a trend line break, but market is again going back up, so this might turn into a false break. The real support is right over here. So it's quite possible that AUD USD currency pair is going to rise up. Okay. Here in 4 hour time frame, we can draw a simple bullish trend line in 4 hour chart. It is telling us that market is probably trying to rise up more in AUD USD currency pair. Next one is the spot gold. Spot gold is showing some kind of a breakdown over here, and I think it's going to continue. Is the daily. So maybe on a short-term basis, we might get a bullish rise. The overall trend is down in daily chart. In 4-hour time frame, seems to me market is trying to find some support. So expect a bullish leg first, and then maybe a continuation of a downtrend in XAUUSD pair. Now let us take a look at some of the questions. So if you have any questions or comments related to today's Forex trading webinar, please feel free to type inside the chat box and I will be happy to answer your questions. Okay, the oil market is going up. As far as the oil is concerned, it's moving up. Okay, there's a question related to the inverse relationship with the PPI and GDP. If prices of PPI goes up, economic growth, GDP will slow down. Well, not necessary. There is no consistent or automatic inverse relationship between the producer price index, also known as PPI, and the gross domestic product, also known as GDP. While rising producer prices can increase production costs and potentially slow economic growth if businesses and consumers reduce spending, they can also reflect strong demand and a growing economy. So, in generally, I would say higher PPI can coincide with the stronger GDP if rising prices are driven by robust demand and expanding economic activity. Okay, let's see. So let us review what we have learned today. Well, we discussed about the CPI, Y over Y in United Kingdom, and the unemployment rate in Australia. And I also showed you some charts of Euro USD, GBPUSD, AUD USD, and spot gold. These are the assets to watch out for profits. What you should do next, stay tuned for the schedule of next week's trading webinar. Subscribe to our social media pages to stay updated with true exciting events, trading content, and market insights. If you want to learn more about Forex trading, visit TradeGeek and access free trading courses for beginner, intermediate, and expert traders. Thank you for staying with us. See you at the next trading webinar on Tuesday, July 28th, 2026, 12 p.m. UTC at the same time. That's all from my side for now. Have a great day and goodbye.